Today we're launching our July bi-monthly report, reflecting on strong volumes of activity in the Irish commercial property market in the first 6 months of 2018. The strength of activity in the Dublin office market has been very consistent during the first half of the year. In announcing excellent half-year results recently, Ireland's Industrial Development Authority alluded to the fact that US businesses, which typically account for approximately 40% of office take-up in the Dublin market each year, appear to be slower to make investment decisions in recent months as a result of US tax changes. From our perspective, there's been no signs of this impacting on demand in the Dublin office market, with particularly strong take-up recorded in the market in the first 6 months of the year, as well as a number of significant transactions currently in negotiations and legals, and several unfulfilled mandates prevailing. Take-up in the second quarter will be significantly boosted by the recent acquisition by Google of more than 22,000 square metres of office accommodation in the Boland's Quay development in the South Docklands of the city. As Brexit negotiations stumble along, Dublin continues to win Brexit-related mandates, with Clearbank Europe, Thomson Reuters, Aspen Insurance and Arch Insurance all recently announcing plans to potentially set up or expand existing operations in the Dublin market. Indeed, the IDA recently confirmed that 42 Brexit-related mandates have been fulfilled to date in Ireland. New research from CBRE shows that Dublin currently ranks 27th in a survey of global office occupancy costs, up from 29th place this time last year. With office rents in the suburbs of Dublin remaining at levels that are at least half that prevailing in the heart of the CBD, there is now tangible evidence of occupiers looking to move to more cost-effective locations such as the suburbs of the city. In addition to a notable increase in lettings to co-working and flexible office occupiers over the last 12 months, we're increasingly seeing organisations introducing flexible working strategies in an effort to reduce costs, improve employee engagement and increase productivity within existing buildings. Having experienced a very strong first half performance, there are several large requirements for office space outstanding at present, and this bodes well for continued activity in the Dublin office sector over the coming months. Underlying volumes of activity in the industrial and logistics property market also remain solid at the mid-year point, with good take-up levels recorded in the first half of the year and several new requirements having been enacted in the last couple of months. In addition, a number of large transactions are currently in legals, and this will provide a welcome addition to take-up activity in the industrial and logistics sector in the second half of 2018. A large proportion of active requirements in the industrial and logistics sector are related to the evolution of e-commerce, with increased appetite from logistics providers, couriers and parcel delivery companies of late. There's also been a notable increase in requirements from the food sector in recent months. In addition to a small number of speculative schemes that are presently under construction in the capital, there's good momentum in the build-to-suit market at present. Appetite for data centre sites is also particularly strong, and that's encouraging, although sourcing sites continues to prove challenging with very little industrial zone land on the market for sale. Research conducted by CBRE Ireland on the 25 most modern industrial and logistics parks in Dublin showed an average rate of vacancy of about 8.4%. Indeed, 4 of those schemes, the M50 Business Park, M1 Business Park, Horizon Business Park and Grange Castle Business Park, all boasting full occupancy at this point in time. Prime industrial rents in Dublin remain stable at the mid-year point at approximately €9.50 per square foot, although rents for prime provincial schemes have increased in recent months. Meanwhile, prime industrial yields remain stable at 5.5% at the mid-year point. While the UK retail sector has been dominated by negative news flow in recent months, the Irish experience is wholly different, with retail sales, consumer sentiment and footfall having been increasing steadily over recent months. Indeed, the most recent data from the Central Statistics Office shows that retail sales in Ireland grew by 4.7% year on year in May, after a somewhat volatile period earlier in the year when activity was impacted by severe weather events. Meanwhile, Visa's latest Irish Consumer Spending Index showed a 15th consecutive month of growth. From the point of view of the retail property market, after a somewhat slow start to the year, there has been good occupier activity in the second quarter, with several transactions having completed recently. There's been an increase in planning activity also over recent months, and retailers are encouraged by the prospect of some new stock after many years of undersupply in this particular sector. Prime retail rents remain stable, with the exception of Dundrum Town Centre, which has seen an increase in Zone A rents over the last number of months and currently standing at €4,600 per square metre. Before the traditional autumn season, the focus for the coming months is to complete various transactions that are currently underway in the retail sector, which will see new rental evidence materialising in due course. Following the completion of almost €1 billion of investment transactions in the Irish market in the first quarter of 2018, activity has continued at pace over recent months. Although a somewhat lower outturn is expected for Q2 2018, there are several sizable assets being marketed at present, which will boost transactional activity in the third and fourth quarters of the year. Some further Asian investment is expected to materialise in the second half of 2018. Notable investment transactions announced recently include the sale of 274 apartments and an adjoining 4-acre site at the Grange in South Dublin for a reported €160 million, a retail warehouse scheme and offices at West End Retail Park in Blanchardstown in West Dublin for €147.7 million, and a 262 apartment scheme at Fernbank in Churchtown, which sold for €138.5 million. Investors from a range of jurisdictions continue to be attracted to real estate opportunities in the Irish market, attracted by buoyant economic fundamentals, the relative strength of occupier market activity, as well as comparative pricing. The recent ECB announcement that interest rates in the Eurozone are expected to remain at current levels at least until the middle of 2019 will ensure that the considerable arbitrage between 10-year bonds and real estate yields, which has been so supportive of investor demand for real estate in recent years, will remain for some time yet. Prime yields in all sectors remain stable at current rates at the mid-year point. We envisage a further shift in the sectoral split of investment spend over the coming months, with an increasing proportion of investors seeking alternative investment opportunities. PRS, or build to rent, continues to evolve as a mainstream sector of the Irish investment market in its own right. Indeed, the volume of capital chasing residential investment opportunities in Ireland's main cities, primarily Dublin and Cork, continues to escalate, with several investors who heretofore focused primarily on traditional investment sectors such as offices and retail, now willing to consider investment opportunities in the residential sector. To some degree, this is a diversification play on a sector that is less susceptible to cyclical patterns, but investors are also attracted by the attractive yield profile and rental growth prospects in an Irish context. Most of the capital targeting PRS or build to rent in the Irish market is looking to invest over a long-term horizon, which is encouraging. Activity has also been brisk in the development land market over recent months, with strong demand prevailing from both domestic and international bidders. Very little of scale was offered for sale in the development land market in the opening months of the year, but this has changed and there's been a notable increase in the volume of stock, including some sizable land parcels, coming to the market over recent months. This is welcome, considering the supply shortages inherent in many sectors of the market at present, most notably in the housing sector. An increase in the volume of stock being offered for sale will give a welcome boost to transactional activity in the development sector in the second half of this year, with 2018 land sales now expected to surpass last year's volume of approximately €750 million. The recent publication by the Central Statistics Office of a new and more accurate housing completion series for the Irish market is broadly welcomed. This new data series confirms that only 14,446 housing units were developed in the Irish market last year, less than half of the volume that is actually required, suggesting that although house building activity in the Irish market is clearly increasing year on year, considerable efforts are still required to increase production further and attempt to meet the country's housing needs. There's been increased appetite for residential sites of late, helped to some degree by the release earlier this year of revised apartment guidelines, which have provided bidders with more clarity and certainty from a pricing and viability perspective. Planning activity has also increased, with planning permissions up more than 80% year on year in the first quarter, and a particularly notable increase in applications for apartments. The market is now eagerly awaiting the Minister for Housing's direction on height and density, which is expected later this month. This will provide further clarity in pricing development sites. In addition to providing residential units for sale, several bidders are now pricing sites on the basis of providing purpose-built, build-to-rent stock, purpose-built student accommodation and/or co-living accommodation. Against a backdrop of a strong domestic economy, increased corporate activity, healthy tourist numbers, enhanced connectivity and a recent spell of nice summer weather, Irish hotels are performing well at present. Tourist numbers and performance measures including occupancy, average daily rates and RevPAR are all up year on year, and the market is on track for a particularly good summer season. Recent data shows that 3.9 million visitors came to Ireland in the first 5 months of 2018. Encouragingly, US visitor numbers showed a 13.6% increase in the rolling 12-month period. Meanwhile, activity at Dublin Airport continues to increase, with more than 30 million visitors passing through the capital's airport over the last 12 months, and passenger numbers having grown for more than 50 months consecutively. Both Cathay Pacific's new direct flight from Hong Kong to Dublin and Hainan Airlines' new direct flight from Beijing to Dublin commenced last month, while Norwegian Airlines have recently announced new direct flights between Dublin and Toronto. Increased connectivity will provide a significant boost for both businesses and tourism, and will help Ireland to attract visitors from new destinations to compensate for any reduction in UK visitors as a result of Brexit and sterling-euro differential. Against this positive backdrop, appetite for hotel properties remains strong. However, with demand for opportunities continuing to outstrip supply, the volume of completed hotel sales in the first half of 2018 has been disappointingly low, with only 8 hotel sales totalling more than 214 million between them having traded in the first 6 months of the year. As we have highlighted for some time, the volume of completed sales in the year to date masks considerable activity underway in the background. After several years of deleveraging when hotels were actively traded publicly, a number of Irish hotel properties are now being offered for sale in off-market processes, with several such transactions underway at present. Therefore, the volume of hotel sales completed in Ireland in 2018 looks set to comfortably exceed last year's total of approximately 400 million, despite the low volume traded in the first 6 months of the year. We continue to see international hotel brands looking for opportunities in the Irish market, and in particular in Dublin. The Hodson Bay Group recently signed a deal with Hyatt to operate their first Irish hotel, a new 234-bed hotel in the Liberties in Dublin 8, which is due to open in 2019. The lack of opportunities to acquire existing hotels is resulting in greater development activity from parties that are prepared to forward fund and pre-let hotels. Despite the volume of hotel properties in planning, the new stock coming on stream in the foreseeable future remains low, however. Dublin will see some additional hotel rooms coming on stream later this month, however, with the opening of the 140-bed Maldron Hotel on Kevin Street in Dublin 8. While there's also strong demand for Dublin licensed premises, the volume of pubs traded in the first half of 2018 has been relatively low, with only 10 Dublin pubs totalling approximately 17.3 million between them having changed hands in the first 6 months of the year. Appetite for investment opportunities in the Cork market also remains strong at the mid-year point, following a busy couple of months which saw a number of notable transactions completed and several assets formally launched for sale. In addition, there's quite a lot of activity underway off-market, with demand for PRS and build-to-rent, as well as office investment opportunities, particularly evident at present. Indeed, there's been very good demand for the Citygate building at Mahon, which is let to Quest and currently being marketed on a sale and leaseback basis through CBRE, guiding €21 million. There's been continued momentum in the office occupier sector in Cork over recent months, buoyed by the recent announcement that KPMG will lease more than 2,700 square metres in a new office development plan for 85-86 South Mall in the city. Negotiations are continuing on a number of other leasing mandates which are expected to be finalised and announced over the coming months. Our research indicates that prime rents in the office and industrial sectors in Cork have both risen in recent months, with prime office rents in the city now trending at approximately €350 per square metre and prime industrial rents currently in the order of €86 per square metre in Cork. All in all, the Irish commercial property market is now set to take a welcome pause for breath after what was a very busy first half to the year. The focus for July and August will undoubtedly be on closing out many of the transactions that are currently in legals or in negotiations before the next surge of investor and occupier activity kickstarts in the autumn. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.